Now let's have a look at how we can use the current ratio to assess the liquidity of a business. So first of all, interpreting the current ratio. If we have a ratio of 1.7 to 1, we know we have 1.7 of current assets and $1 of current liabilities. So interpreting that, it means the business has $1.70 of current assets for every dollar of current liabilities. So just as before when we looked at profitability, if we're going to make judgments about the performance of the business in regards to liquidity, we need to compare the current ratio to another result. Otherwise, it's not telling us about what's happened with the liquidity of the business. So we can compare it to results from previous years, we can compare it to industry averages or leaders, or we can compare it to similar businesses. With liquidity, the business needs to make sure they have enough current assets to pay their short-term debts when they fall due. So really, they need a current ratio of at least 1 to 1. A ratio below this may mean the business cannot pay its debts when they fall due, and they may be forced to sell some non-current assets to meet these costs. When we're comparing the current ratio to previous results, a result that is higher than last year is a favourable outcome for the business. This means that liquidity has improved and the business now has more current assets to cover current liabilities than they did last year. However, a result that is lower than last year, this is an unfavourable outcome for the business. It means that liquidity has actually deteriorated over the year, because the business now has less current assets than they did before to cover their current liabilities. So, in comparison to the industry average, if we have a current ratio that is higher than the industry average, so the industry average might be 2 to 1 and we might be 3 to 1, this is a good result for the business. And it's a good result because it means that the business has more current assets to cover current liabilities than other businesses in the industry. However, if we get a result that is below the industry average, this is a poor result for the business. And it means that they actually have less current assets compared to cover current liabilities than other businesses in the industry. So they don't have that same safety margin to be able to cover those current liabilities. However, with liquidity, we have to consider how high is actually too high for the current ratio. Remember, a high current ratio is really good from a liquidity point of view. It means that we have no problems paying our short-term debts when they fall due. However, if we've got too much money tied up in our current assets, this can actually compromise the profitability of the business because those funds may have been better invested in non-current assets because they can generate a higher revenue and return for the business. This, however, is the extension and the extra that you add to your analysis, not the point of default when interpreting the current ratio. So in summary, the business must have a current ratio of 1 to 1 to be able to meet their short-term debts. When comparing the current ratio to last year, higher is better because it means we now have more current assets to cover our current liabilities. When comparing to the industry average, higher is also better. We want to be above the industry average because it means we have more current assets available to cover current liabilities than other businesses in the industry. However, we need to consider how high is too high, and if our current ratio is excessively higher than the industry average, what that could mean is we have too much money invested in our current assets, and that could in fact limit our profitability.